Move over, Anna Delvey, and the brains behind the infamous Fyre Fest. Honestly, when it comes to comparable American scandals, the Satyam situation in India was actually more in the ballpark of Enron. The scam involved many underhanded components, including grossly manipulating company financial records and inflating profits for the sole purpose of deceiving stockholders, as well as pulling the wool over the eyes of auditors and regulators. Significant sums were also embezzled from the company and channeled into the purchase of real estate. The scale of the fraud was estimated to be a loss of 14,000 crore rupees, and the sheer magnitude of the deception immediately shattered the trust of the corporation's investors. But even more than that, the occurrence called long-term Indian corporate governance laws into question. The vulnerabilities in the system were taken advantage of by the perpetrator and his ilk, exposing how small cracks can be exploited enough to create a complete collapse. The brazenness of the fraud showed both financial experts and auditors that the entire Indian system intended to regulate companies like Satyam was irreparably broken and required updating. However, thanks to this notorious financial fraud, the Indian government mended their laws so that both businesses and auditors are held accountable and operating in a manner that is transparent and ethical. Widespread reform was prompted by this event, leaving an unprecedented mark on the Indian corporate landscape. It all came to a head in 2009, but those in the know began to smell a rat as early as the fall of 2008. When the property market started to crash in the Indian city of Hyderabad, a devastating trail of financial fraud was easily traced back to Satyam Computer Services. Whistleblowers came forward as funds disappeared mysteriously. And if Satyam's chairman and founder, Ramalinga Raju, never attempted an iffy acquisition of a failing real estate company owned by family members, who knows how long he would have been able to facilitate one of the largest financial frauds in Indian corporate history. Let's start from the beginning. Satyam was founded in 1987 in India by Raju and offered software development, IT consulting, enterprise solutions, systems integration, and a whole plethora of IT solutions for companies. It became one of the country's fastest-growing IT services businesses at the time. It was so successful that it was listed on the Bombay Stock Exchange starting in 1991, and along with its contemporaries, it became a poster child of India's rise in the global IT market. Satyam was by all metrics a success story, landing many prestigious clients including Fortune 500 corporations throughout Europe and the United States. As the outsourcing trend grew exponentially in the late 90s and early 21st century, the company's growth soared as it was a pioneer in the IT space and was regarded as trustworthy and professional. As a key player in India's technology boom, Satyam earned its place on the New York Stock Exchange, and this milestone only expanded the brand's reach throughout the world, introducing it to new markets. Satyam was thought of a symbol of corporate success both in its home country of India and in a number of foreign countries where the company conducted business. It received positive recognition worldwide as well as numerous awards, including the 2008 Golden Peacock Award for Corporate Governance. Who would have believed that in that very same year, Satyam's mask would begin to slip and its true self would start to emerge? As the year progressed, Satyam's stock started to fall and rumors about corporate financial irregularities started to spread. By December 16th, Raju made a power move that inadvertently crashed his perfectly crafted empire. He announced that he planned to acquire 2 real estate companies owned by members of his family, but investors balked at the idea of spending $1.6 million on Matus Infra and Matus Properties because the acquisition had unclear and confusing motives. Raju felt immediate pressure to call off the deal and did so within 24 hours, but the damage was already done. People were now skeptical. So how did Raju's attempted purchase of the Matus Infra and Matus Properties expose his long-standing fraud? Well, his plan was to use Satyam's fake cash reserves to bail these companies out. The businesses were owned by family members that were struggling due to the 2008 global financial crisis. The plan also benefited him since he was going to use the acquisition to plug the financial gaps in Satyam's books. However, since the idea was rejected by the institutional investors for its ridiculousness, it already stood to reason that the motive behind the attempted acquisition would be investigated. And it was. By December 23rd, the World Bank barred Satyam from business for 8 years. They cited alleged malpractices in securing contracts as the reason behind the decision. This was just another event that added to the scrutiny of both Raju and Satyam as a corporation. But this was nothing compared to the explosive revelations that were about to follow in just a few short weeks. On the 7th of January 2009, Raju sent a bombshell of a letter to Satyam's board of directors, setting the stage for his ugly downfall. He confessed to the full extent of the scam, including how he inflated profits by manipulating years of the company's financial statements. But that was quite an understatement. Satyam's balance sheets reflected 7,000 crore rupees in cash balances, assets, and profits that never existed. He told of how what was initially a small discrepancy on the books ballooned into an incomprehensible fraud that exaggerated accounts and created fictitious cash reserves. Trying to account for his inexcusable behavior, Raju compared his situation to riding a tiger, not knowing how to get off without being eaten. We are obviously shocked by the contents of the letter. The senior leaders of Satyam stand united in their commitment to customers, associates, suppliers, and all shareholders. We have gathered together at Hyderabad to strategize the way forward in light of this startling revelation, the corporation's board declared at the time. But was the Satyam scandal a small mistake that simply grew out of control? Not necessarily. It was more akin to a carefully planned and meticulously executed fraud that exploited many known loopholes in India's corporate governance laws and its financial auditing processes. After all, the business's financial statements were grossly manipulated for years, as were bank statements and invoices. Many fake documents were produced to give credence to inflated figures reflecting revenue and profits. If anything grew out of the control of Raju and his cronies, it was the size of the gap between Satyam's actual numbers and the fictitious ones reported to shareholders. The fake cash reserves were essentially the crux of the far-reaching fraud, with balance sheets reflecting over 5,000 crore rupees in non-existent cash and bank balances. Once these reserves became known to shareholders, Raju had to create fictitious accounts and resort to forging bank statements to cover his tracks. These sneaky moves were not in vain. They helped to artificially raise Satyam's stock value. This meant that Raju and his inner circle would sell their personal shares at a profit while providing the business's investors a false sense of security at the same time. This then led to Satyam's share prices being used as collateral to secure low-interest loans in the United States. Even more loans were secured using the manipulated financial statements. The misappropriated funds were funneled into speculative real estate ventures in and around Hyderabad. Payments on these loans were embezzled from the company and kept off the books. Another fraudulent scheme involved the addition of thousands of fictitious workers to Satyam's payroll. The $3 million in salaries that were allegedly paid to the over 13,000 non-existent employees were falsely recorded on financial statements. Why would they do this? Well, in actuality, these payments were being pocketed by board members and top executives of the company. Apparently, Raju was caught withdrawing the equivalent of nearly $2 million to pay these fake employees. Finally, on the 22nd of January 2009, the Criminal Investigation Department informed the court that only 40,000 workers were actually employed by Satyam, as opposed to the 53,000 that were previously reported. Once news of the scandal broke worldwide, State Farm Insurance and Merrill Lynch, now part of Bank of America, broke all their ties with Satyam. Credit Suisse refrained from covering the corporation. They also had to surrender the prestigious Golden Peacock Award for corporate governance and risk management and compliance that they were previously awarded. By January 7, 2009, trading of Satyam's shares was suspended on the New York Stock Exchange, causing them to drop from $29.10 a share in 2008 to $1.09 in March 2009. Following suit, India's national stock exchange removed Satyam from its S&P CNX Nifty 50 share index on January 12th, following a drop to 11.50 rupees a share, down from 544 rupees in 2008, the lowest since March 1998. Once Raju confessed, Satyam's proverbial dominoes fell fast. On January 8, 2009, the corporation's bank accounts were frozen while the interim CEO was forced to publicly acknowledge the company's severe cash crunch. The next day, both Raju and his complicit brother Rama were arrested on multiple charges, including breach of trust, forgery, and criminal conspiracy. By the following day, the Crime Investigation Department detained Satyam's CFO at the time, Vadlamani Srinivas, for questioning. He was then arrested and placed in judicial custody. The Indian government intervened immediately by sending the company law board to suspend the existing board at Satyam and replace it with 10 newly appointed directors. Deepak Parekh, a prominent Indian banker, former NASSCOM president Kiran Karnik, and former Securities and Exchange Board of India member C. Achuthan were among the chosen. Corporate Affairs Minister Premchand Gupta commented at the time, "The current board failed its duties. We must safeguard the IT industry's reputation." A.S. Murthy was appointed as the new CEO, with Hami Khusrokhan from Tata Chemicals and chartered accountant T.N. Manoharan named as special advisors. Once February rolled around, the Central Bureau of Investigation took over the investigation. They issued 3 separate charge sheets on April 7, 2009, November 24, 2009, and January 7, 2010. However, all the charges that were identified during discovery were eventually consolidated into one comprehensive charge sheet for a more streamlined prosecution. Surprisingly, the Supreme Court granted bail to Ramalinga Raju on November 4, 2011, after more than 2 years of legal challenges. Many were disappointed in the legal system, feeling that much more stringent consequences should have been applied to the conductor of such a complex fraud. Apparently, this occurred because the Central Bureau of Investigation never filed the charge sheet, despite having 33 months from the time of Raju's arrest to do so. By July 16, 2014, the Securities and Exchange Board of India banned Raju from the market for a period of 14 years. He was also ordered to return 1,849 crore rupees. A few months later, once all legal proceedings were completed on April 9, 2015, Raju and 9 of his accomplices were convicted of conspiring to inflate company revenue, falsify accounts, manipulate tax returns, and create fake invoices. A Hyderabad court sentenced them to 7 years each in prison. Additionally, Raju's co-conspirator, Kunjamani, and his brother received fines of 55 million rupees each. That's approximately $883,960 in United States currency. One of the worst aspects of the entire Satyam ordeal was the failure of auditors when it came to detecting the fraud. PricewaterhouseCoopers specifically was responsible for auditing Satyam's financial statements during the time that the scam was perpetrated. As one of the largest and most trusted auditing firms in the world, it is certainly perplexing that many glaring discrepancies were completely under the radar for so long. This raised many serious questions about the prestigious firm's auditing practices. By January 14, 2009, representatives of Pricewaterhouse, the Indian arm of PricewaterhouseCoopers, admitted that its audit reports with regard to Satyam may in fact be inaccurate and unreliable, but excused the oversights it made as due to the misleading information provided by Satyam's management, which is relied on. A show-cause notice for financial misrepresentation was issued to PricewaterhouseCoopers by President Ved Jain of the Institute of Chartered Accountants of India, which regulates chartered accountants. This was done with the intention of addressing audit failures at the company and restoring confidence in governance itself. The firm was banned by the Securities and Exchange Board of India in 2018 from auditing any listed Indian companies for 2 years and was required to disgorge of more than 13 crore rupees in wrongful gains. This is because the board found the company to be complicit in the fraud due to their lax auditing standards. Additionally, it was later fined $6 million by the U.S. Securities and Exchange Commission, specifically for its failure to adhere to professional auditing standards and conduct while auditing Satyam. This spotty auditing raised fundamental questions about Indian corporate governance standards and the reliability of auditing processes in the country. After all, it is the auditors that are the de facto gatekeepers of financial integrity, and with major gaps in regulatory laws, many more auditors may be exploited by shady businesses for their own personal gain in the future. That is why the Indian government introduced several reforms in the wake of the Satyam fraud. One of the most important changes made to Indian corporate law after Satyam was the introduction of the 2013 Companies Act, which was a modified version of an earlier law, the severely outdated Companies Act of 1956. The 2013 upgrade included much stricter laws overlooking corporate governance, as well as mandatory enhanced financial statement disclosures and the required rotation of all auditors every 5 years, and all audit firms after a decade of service. The latter prevents auditors and audit firms from becoming too friendly with company management, ensuring greater objectivity and independence as part of the auditing process. Another reform related to the Satyam fraud was the debut of what is called a Director's Responsibility Statement. This is an instrument that all company directors must sign that pledges their personal responsibility for the accuracy of all the financial statements set forth by their company. This provision in the law keeps directors from feigning ignorance and innocence in the event of financial fraud and holds them rightfully accountable. The Indian government also established the Serious Fraud Investigation Office under the Companies Act of 2013. This is a statutory body that is tasked with investigating all complex financial frauds and ensuring that the perpetrators are brought to justice. The government also did its best to intervene at Satyam and prevent the company's complete collapse. They were instrumental in facilitating the sale of the business to Tech Mahindra, part of the Mahindra Group. This was done through a formal auction process after Tech Mahindra acquired a 31% stake in Satyam in April 2009. Subsequently, the company was rebranded as Mahindra Satyam, and it was formally merged with Tech Mahindra in 2012, creating one of the largest IT companies in all of India. The acquisition and subsequent merger helped restore investors' confidence in the brand and ensured the survival of Satyam's everyday business operations. Though Satyam was able to ride through the storm, the fraud perpetrated by Raju and his associates left an indelible mark on India's corporate law and business practices. It served to highlight the importance of ethical conduct in business, including transparent auditing practices and the formation of strong laws with regard to corporate governance. Without robust regulatory oversight, frauds like the Satyam scandal are likely to continue, and the aftermath of the scam did coax the government to put stronger provisions in place to prevent any recurrences. Fortunately, the far-reaching effects of the scam led to these much-needed reforms and financial oversight that the country was sorely lacking.